Thank you, Tamar. I got your message. So we are here today in another financial empowerment workshop. This one's going to be a little different than the one we had. Great ones so far. We talked about using credit cards and what that's all about. We also talked about budgeting and what it's really like to live like a millionaire. So, okay, thank you, Dej. So we are going to now have another discussion, and the two gentlemen joining us today, they're going to introduce themselves and their organization a little more. I know it's called By the Hood, and we have Corey Camp and Jimmy. I'm not sure what your last name is, Jimmy, sorry.
It's okay.
And you're going to introduce yourself. You can take it away.
All right. Do I have the ability to share my screen? All right, cool. Let me share my screen. First of all, good morning, everybody. Thank you.
Good morning.
Good morning. All right, so let me see. Corey, is my screen?
Yep.
All right. Let me put this. All right, cool. So this is our organization here, known as By the Hood. That's our website there, bythehood.com. Again, I just want to say thank you guys for the time. I'm going to go through the presentation so then we can have like an opportunity to answer any questions. If you do have questions during the course of the presentation, though, you could just put them in the chat and we'll try to address them as we go through. But I want to make sure I, get through the presentation first. So our organization is called By the Hood. And we're going to tell you a little bit about ourselves. First and foremost, anything that we say is not investment advice. Our attorneys make sure we put this in all of our presentations. It's for educational and entertainment purposes only. I just have to say that because we're not trying to make you just run out and just go buy anything that we say. But we do want to educate you on the reason why you need to know about investing. And especially at your age, you have an advantage over a lot of people if you start to just listen and understand this information at an early age. So I just want to say that first and foremost. A little bit about myself. That's my last name there. It's Jimmy Williams. Have a bachelor's degree in business management, a master's degree in real estate property management. I've been a licensed real estate agent for a long time. I've bought and sold millions of dollars of real estate. I've invested in precious metals since 2008. I've been a cryptocurrency investor since 2016. I used to work in life insurance. In terms of real estate, I'm an analyst, a real estate developer, a landlord. So anything in real estate I've done, but I'm also a certified Bitcoin professional, which is something we're going to talk about too. We're going to, weave in a little bit of cryptocurrency in here as well, because I've also studied that. I have 2 books that I've published, and I'm the founder of bythehood.com. My most recent book is called Own Your Time and Space, and it's co-written with my partner right here, Corey. So I'll let Corey tell a little bit about himself.
Hey, how y'all doing? My name is Corey Camp. I have my undergrad degree in the administration of human services. I've been an educator for 20 plus years, so I've been teaching in one form, shape, or fashion for the last 20 years. Owned a lot of different kinds of property, commercial property, private property, but I'm not a landlord. I'm more into the buy and flip than the buy and hold. I trade options. I have been trading options since 2016. I've been in crypto since 2016 also. I invest in precious metals the same way that Jim does. So we're well-rounded investors here. I own an educational consulting firm called Baby Camp LLC with my wife, where we help children with special needs get the services they need from schools. And we also help schools to provide services to those students on the back end and help them clean up their paperwork and stuff so that the students can get the things that they need. Our course creation for By the Hood, I'm the educational piece to the By the Hood, co-founder of our ownership camp, which we just completed, and a published author with my brother right here, Jim, of Own Your Time and Space. So that's who I am.
All right. So that's a little bit about us, but now we're going to get into a little bit of discussion about some money. Now, and you can answer this in the chat. Has anybody ever heard of the rule of 72?
Anybody?
Yeah, and you can put yes or no in the chat. There's no right or wrong answers. I'm just trying to see if anybody's ever heard of this. And I'm glad you guys have already had some courses on budgeting, because that's very important. That's probably the first thing you want to understand is how to budget. But what we're going to talk about is why you need to learn to make your money work for you. So we do have some stuff in the chat. Cool. I don't know if you can see it.
Yeah, most of the people said no. We had 2 yeses.
All right, cool. So some of you have, some of you haven't. Now, for those that haven't heard, make sure you get a notepad. If you don't remember anything that we say during this presentation, remember this, because this is very important. The rule of 72 tells you how long it takes for your money to double, right? So now, if you have money in a bank account, your bank is going to pay you interest on your money. So if you deposit money into your bank account, your bank is going to pay you interest on your money, right? And I want you guys to take a guess at how much interest your bank is going to pay you on the money that you put in your bank account. And there's no right or wrong answers. I just want to see what you guys think.
What percent interest do you think a bank pays in your checking or savings account?
And you can put it in the chat, whatever you think. Just take a guess. I just want to see what you guys are thinking.
8%.
Okay, we got 8%. Anybody else?
1% or less.
Okay.
7, 5, 0.1, 0, 15.
Okay, so we have a range. We have a nice little range. I see the highest 15. I saw 0.1. So I'm going to ask Corey to answer this question. What does the average bank account pay in interest during the course of a year?
0.2%, which is 1/5 of 1%.
So that's the average, right? Now, that means that your bank is paying you less than 1% on an annual basis to put your money there. So that's what your bank is going to give you on your money. So what the rule of 72 does, it tells you how long it takes your money to double. So it's a simple math equation in the rule of 72. So let's get to it. So you take the number 72 and you divide it by the interest that you're making on your money, right? So if you're making 4% on your money and you divide that into 72, the answer that you get tells you how long it takes your money to double in years. So if you're getting 4% on your money, right, U72, that means that it takes 18 years for your money to double.
You'll live 18 years, so that's not terrible. That's not bad.
Now, with that being said, the bank doesn't pay you 4%. We just told you what the bank pays you. The bank pays less than 1%. So with that being said, let's just say it's 1% for argument's sake to make the math easy. That means that it would take 72 years for your money to double. So as you see, as you increase the amount of money that you're getting in interest, the lower time frame it takes for your money to double. So that's why I said I want you guys, if you don't remember anything else that we show you this morning, remember the rule of 72, because the rule of 72 is something that you can use in any sort of business, any sort of investment. If you invest in real estate and you figure out how to calculate your rate of return, you divide that into 72, that tells you how long it takes your money to double. If you decide to go buy a case of waters and you want to, stand on a boulevard and sell waters, you figure out what your rate of return is. How much money does it cost to buy the case of waters? And how much money am I going to make? You figure out what your rate of return is, divide it into 72. That's how long it takes your money to double. So the rule of 72, if any of you guys like are sneakerheads and you want to, go online and buy and sell sneakers, the rule of 72 applies. So this applies to any business. It's a mathematical equation. Just take the number 72 and divide it by whatever return you're making on your money, and your answer shows you how long it takes your money to double. And as you can see, the more interest or the more return that you get on your money, it showed that the years actually decreased. Everybody get that?
Yeah, so we have a question, Jim. So
Sure.
The question said, does that mean they shouldn't put their money in banks?
Great question. I like that question. That's a great question. Now, not necessarily, because there's certain parts of your savings that you want to have for an emergency, right? So as you start to invest your money, you can invest your money a number of ways. The one thing you don't want to do is have to sell one of your investments because of an emergency. So because of that, you want to have some of your money in a regular bank account just so you can get to fast for an emergency, right? You guys also learned about credit. You don't want to ruin your credit, right? So one of the things you should learn to have is to have savings, kind of like a rainy day fund, like if you need it. So that's what a bank account is used for, to put money that you might need on a short-term basis for an emergency or something like that, right? But you don't want to take all of your money and just put it in the bank. You don't want to invest in just saving your money in a bank account. You want to find ways to take your money and make your money work for you, right? So one of the our book that Corey and I wrote together called Own Your Time and Space, what it's about is when you start to understand what money is actually time. right? Money is time. You know, if you know someone that has to get up and go to work every day, what they're doing is they're exchanging their time for a paycheck, which is money, right? So anytime you have money, that's someone's work that they've put in for however many hours it took them to make that money. So when you start to make your money work for you, now what you're doing is you're buying time. You are literally buying time, because it can get to the point when you start to put your money to work for you where you don't have to work for it. The idea is to make your money work harder than you do, right? Now, if you know how to get 24% of your money will double every 3 years. The higher that number goes, the lower the years, right? So if you don't remember anything else, remember the rule of 72, but we'll keep it pushing. I want to see if you guys have been paying attention, right? Let's say you know how to get 30% on your money. How many years will it take for your money to double? If you have a phone or your computer, you can use your calculator. I just want to see if you know how to, put this together. And you can put the answer in the chat. If you know how to get 30%, and ROI means is, that's the rate that you're getting back, return on investment. But if you know how to get 30% on your money, how many years does it take for your money to double? You can put the answer in the chat if anybody has the answer.
2.4.
Okay.
All of them are putting 2.4.
All right, so you guys got it, right? So you guys have picked that up, right? So like I said, if you remember anything else, remember that, and that applies to any sort of business. If you're selling things on eBay, if you're selling things on Amazon, if you're, like I said, I know a lot of people in Philadelphia, but kids will buy waters and stand out there and buy waters. It's one thing to know how to make money, but do you know how much money you're actually making? What is your rate of return? So
we have a question before we move
sure.
on. Is the higher rate of return does the higher rate of return typically bring more risk?
Great question. You guys are on it. That's a great question. It can, but that's why you learn to, analyze and evaluate your investment
And mitigate risk.
Yep, because you want to mitigate risk. It can bring risk, but also if you know what you're doing, you can lower the risk and still get the higher rate of return. But that's
education is the thing that mitigates risk. So it might seem risky to a lot of people, but if you know what you're doing, it won't be risky to you.
But I don't know who asked that question, but that's an excellent question, by the way. You guys are on it. So here's a quote from an author called Robert Allen. It says, "Why not just a savings account? How many millionaires do you know who have become wealthy by investing in a savings account? Well, I rest my case." The point he was making with that is basically, you can't just put your money in a savings account. It doesn't work that way. You just can't put your money in a savings account and expect to create wealth. That's not how the system is set up. Now, I'll let my brother Corey sit here and explain to you how banks work. Now, I do want to say this before he gets into this. It's a lot deeper than this when we talk about banks, but we want to talk about just simply, real simplified way to talk about how banks work. And the reason we do this is because we want to teach you guys to start to think like a bank. We want you guys to become your own bank. And when we say be your own bank, we're not talking about having a big structure and having buildings. We're talking about the philosophy that banks use in order to make money. Go ahead, Corey.
All right. So what happens when you go to a bank is that banks take in money. Oh.
You all right?
Hello? Hold on one second. All right, I'm sorry. I did something on my screen. My screen just flashed out on me.
Go ahead, you got it.
All right. So banks take in money. And so they take in money from a lot of sources. So let's just say all of us in the room went to a bank. It's 30 of us, and we all put $100 in there, right? So just 30 of us put 100 in there. It's $3,000 in the bank, right? What the bank will do is they'll pay us 1/5 of 1% on that money, right? But then what they'll do is they'll lend it out for mortgages at 3%. They'll lend it out for car loans at 6%. They'll lend it out for student loan at 18%. They'll lend it out in credit cards at 18%. So what they're doing is taking money in that 1%, and they're paying us. They will pay you 1/5 of 1%, but they're putting that money back out at 3%, 5%, 8%, 18%, and they're making all the money in between. So hypothetically, if me and you go into the bank and we both put $1,000 in there, right? And then I go to borrow $1,000, they literally lend me my money back at a higher rate than I put it in there at, right? If I take $1,000 to the bank, and then they'll pay me 1/5 of 1%, and then they lend it back out to me. The minimum they'll lend it back out to me is at 3%. And so they'll literally take the same money I put in the bank and lend it back out to me at a higher rate. And that piece in the middle is how banks make their money. Now, banks make their money in a lot of other different ways. They charge fees. They put their money in the stock market. They do a lot of other different things. But basically, the very basis of what they do is to take money in at one rate and put it back out at another rate. And so we can do that. We can do that. We can become our own bank.
Yeah. So, and that's why. So, I mean, how banks work, we could do the whole course on that, how banks work, but we just want to, like, share that short piece, because the idea is to understand how to get money at one rate and then use that money to make a higher rate. And that's kind of what we're talking about when we say be your own bank. We talk about that a lot in our community, like, hey, we got to be our own bank. We have to be our own bank. So a lot of the different avenues that we work in, we focus on figuring out ways to become our own bank, because when you think about a bank doesn't really contribute a lot to society. Like, they don't, make clothes. They don't make cars. They don't, give off electricity. All they do is take money in at one rate and put it out at another rate, right? And provide some level of security. So that's how a bank works. We want you guys to start thinking like a bank, right? Now, some of the things we talk about are real estate, right? So we're going to talk about 3 asset classes here this morning. In our community at By the Hood, we generally talk about 4. The fourth one is precious metals. We're not going to really talk about that, but we're going to talk about real estate. So why do people invest in real estate, right? People invest in real estate because of something known as leverage. All that means is, if I go to buy a property, let's just say for argument's sake, the property costs $100,000. I don't have to come with $100,000. Right? I can have $20,000, sometimes $3,500, like $3,500. Sometimes I can have as low as $3,500, and I can buy $100,000 properties. That's called leverage, right? So one of the main reasons that people invest in real estate is leverage. I don't have to have all of the money up front, to buy the property, right? It generates passive income. Now, what is passive income? Passive income is when you buy something or create something and it pays you without you having to actively do anything. If you go to work every day, that's called active income. You have to get up, you have to go to work, and you're creating what's known as active income. Passive income, let's just say I'm a rapper and I write and I make an album. I create the album one time and I put it out there on iTunes, and then every time somebody buys it, I get a part of it. That's passive income. But with real estate, if I buy a property, right, and I put a tenant in that property, they're going to pay me rent every month while I go do whatever it is that I want to do. So that's passive income, right? So real estate allows you to generate passive income. Land will always have value. So everybody here, right, let me ask you a silly question. And I know it's silly, but it's to prove a point. How many of you guys live in a house or an apartment? You don't even have to answer that in the chat. Everybody lives somewhere. I don't care where you live somewhere. Everybody works somewhere, everybody lives somewhere, right? That's because land always has value, right? And there's a reason that land always has value. There's an acronym. You don't have to write this down or anything. I'm just, just spewing why land always has value. It's an acronym known as DUST, D-U-S-T. And what that stands for is that land is desirable, land has utility, land is scarce, which means there's not too much of it. Like, they aren't creating any more land. And the T is transferable. I can own land and I can sell land to Corey, and Corey can sell land to you. So it's transferable. So that is the reason why land will always have value. Now, other reasons that people buy real estate is because over time, real estate tends to appreciate, which means that it goes up in value. If you guys had bought a piece of property 10 years ago, right now it's probably worth more than what you paid for it. That's another reason why people buy real estate, right? Is because over time it appreciates. Real estate gives you control. So a lot of times when we talk to people about investing, the reason they choose real estate over other asset classes are because they feel as though they can control it, they can see it, it's tangible, they can pull up in front of their property and say, hey, I own that property. Are any of you guys interested in getting into real estate? You could put a yes or no in the chat. I'd just like to see what you guys think about real estate. All right, somebody says I live in South Philly and the values are rising like crazy, right? So we got a lot of yeses in real estate, right? So Cool. That's good to know, right? Because real estate is something that will always have value. It helps you generate passive income. You can use leverage in real estate. So this is why real estate is one of the asset classes that we're talking about. And as you can see, the little logo there is from Monopoly. And I don't know if you guys ever played Monopoly, right? But Monopoly is probably the greatest game there is, because Monopoly actually happens in real life. So sometimes we're playing and we're just trying to win the game. I know Monopoly games in my house used to be crazy, but the fact of the matter is there's a lot of life lessons in Monopoly. And I'm going to give you one before we move on. And the fact of the matter is, when you play Monopoly, let me ask you guys a question. You know how when you go around Monopoly, what happens when you pass go? Somebody give me the answer to that in the chat. What happens when you play Monopoly and you pass go? If anybody that's played Monopoly. Yep, there we go. I see it in there, right? You collect $200. You collect $200. Now, let me ask you another question. If we're playing Monopoly and you don't do anything else, but you just keep going around the board and you're collecting $200, do you think you could win the game by just going around the board collecting $200? Yes or no?
Nope.
All right, so we got no in the chat, right? Now think about this. In life, that's what people do. People get up, they go to work every day, and every 2 weeks, they'll get their paycheck, right? That's them pass and go. And they don't take that money to invest. And when they don't take that money to invest, guess what? You won't win. It's the same thing as Monopoly. So you have to understand that the only way to win in life is to use your money to make your money make money. So when you invest on a Monopoly board, when you buy a property, you're investing in that. And when someone lands on it, they have to pay you. It's the same thing in real life, right? I don't care whether you prefer the stock market or you prefer real estate. The idea is this: you can't just keep pass and go and expecting to win. That doesn't work. You have to learn. And we showed you the rule of 72, which is why, right? There's something else that we're not going to get into because we don't have that much time, but there's a concept that's known as inflation, right? And we'll talk a little bit more about inflation when we get into cryptocurrency, but just briefly while we're here in real estate, inflation is the cost of goods and services going up. So you may have heard your mother or aunt or someone or grandparents say, when I was a kid, gas cost this, or bread cost this, or milk cost this. So over time, the cost of goods and services go up. And, we can dig deep into why that happens. But the bottom line is it happens. So the rate of inflation, if you look it up, is probably somewhere between 2 and 4%. I mean, I believe it's a lot higher than that, but that's what's reported. So the fact of the matter is, even if you just put your money in your mattress or in a shoebox, you're literally losing money by not investing. That means that if you did nothing wrong, you went to work and you got your check and you just put it into a shoebox, you are literally losing money because your money is sitting still while the cost of things are going up. So your money has less purchasing power. So if I have $10 today, I can't buy in 5 years with $10 what I can buy right now.
Your money will never be worth more tomorrow than it is today.
Exactly. So that's why the rule of 72 is important. That's why, and again, I want you guys to ask questions as we get to the end of this, but you can ask questions as we go along as well. But we're just trying to talk about some concepts and show you guys some things in a little bit of time that we have here with you. So just to open your eyes up and make you think a little bit different. Our objective this morning is to try to get you guys just to think a little bit different, right?
All right. So we had a question about how to increase ROI. How do you increase your ROI?
Great question. You guys got a lot of great questions. How to increase your ROI is to analyze whatever asset class you want to be in. So some of the asset classes we're talking about, we're going to talk about real estate, right? We're going to talk about the stock market. We're going to talk about crypto. You have to invest your money to increase your ROI. So Core, I'm going to let you talk a little bit about the stock market and why the stock market.
All right. So according to historical records, the average annual return for the S&P 500 since its inception in 1928 through 2014 is approximately 10%. That number is higher now. That's around 12% right now, because in the last 6 years, the stock market has gone nowhere but up. So the average return since the S&P started in 1928. So basically for the last 100 years, if you had invested in the S&P 500, which is the 500 largest companies by revenue, you would be up 10% per year. And this is compound, right? And so basically compounding that money over those years, you would be the difference between linear interest, which pays you the same amount every year, and compound interest is something totally different. So the stock market allows you to have ownership in companies and billion-dollar companies, right? You don't need to know how to run a billion-dollar company if you can identify a billion-dollar company and have someone else run it for you. That's what the stock market allows you to do.
All right. I got two questions for you guys. I want you to answer both of these questions in the chat. The first question is, what is your favorite social media site? And the second answer is, what is your favorite sneaker brand? I want to see what you guys say in the chat.
And we do have two questions too, Jim.
Mm-hmm.
So after this. So it would double every 7.5 years. Yes.
At 10%.
At 10%, but it's actually higher than that.
All right. So we got an Instagram and Nike, Instagram and Jordans, TikTok and Nike, Instagram and Nike, Air Jordans, a lot of Air Jordans, Instagram and Vans. Okay, nice. Instagram and Vans, a lot of Instagram.
TikTok and Nike.
Instagram,
okay. TikTok.
All right. Now, the reason I say that is this, right? So when you talk about the S&P 500, and Corey just said that the S&P 500 are the top 500 companies by revenue, that includes a lot of the companies that we use in things that we consume, things that we do on a day-to-day basis. So we actually use a lot of these companies, but most people don't recognize that you have the ability to own these companies, right? Give you an idea, some popular brands. Many of you guys probably, I saw someone before we came on was actually on an iPhone, right? So Apple. A lot of us shop at Amazon, right? You see Louis Vuitton there, who owns a bunch of brands, by the way. Xbox is Microsoft, Google, even wrestling. WWE is a publicly traded company. Most of you guys mentioned Nike, right? ESPN, if you watch ESPN, Pepsi, as well as Coca-Cola, as well as McDonald's, as well as Wendy's. All of these things are publicly traded companies that you can actually own equity in. So we had a couple questions I want to get back to before that. It was about
one was about the IRA and the Roth IRA.
All right, how old do you have to be to set up a 401k? Good question. Now, the thing about a 401k is this. It all depends upon which kind of 401ks. All 401ks aren't the same. If you have a job and they give you the ability to go 401k, that's one thing. You also have other investment vehicles that are similar, like a SEP IRA or a regular Roth IRA, which was mentioned, or you have the Roth 401k, which in my opinion is one of the best products there is. It all depends upon where you're working, how you're working. Are you self-employed? Do you have a job that has a 401k? So it's really difficult to answer
your
that
parents
question.
can set one up at birth, basically.
Well, it depends, right? Now,
depending upon.
Here's why. Because in order to get a retirement account, even as a kid, you have to show that you have some sort of income, and the IRS isn't crazy. The IRS wants the work to be something that's age appropriate, right? So if you have a 5-year-old and you try to set them up a Roth IRA and you say that they're one of your roofers in your roofing company, that's not gonna work.
You're going to jail.
Yeah, you can get yourself in trouble. Now the Roth IRA is a very, very powerful vehicle. The Roth IRA allows you to take money that's already been taxed and you put it into a vehicle and it can grow over time.
Untaxed.
Yeah, untaxed, and you know, so it's a very, very powerful vehicle. But there are a lot of vehicles like that. And if you guys need specific questions, we could talk one-on-one to help. So what is a 401k? All right, so a 401k, great question. You guys got some amazing questions. A 401k is a retirement vehicle. So if you work for a company, right? So I'll give an example. A company I used to work for years ago. I used to work for Johnson & Johnson, which is a big company. And we had a 401k. So our 401k would be money that came out of our checks before we got taxed, and it would be put into a vehicle. And as it grew over the years, as the rule of 72 worked and the stock continued to go up and go up, I didn't have to pay taxes on that, right? I didn't have to pay taxes until I get older and I want to take away from my 401k. So it's a retirement account is what a 401k is. Now, the reason I want to show this real fast about these brands are because there are a number of brands. A lot of you guys mentioned Instagram, which is owned by Facebook, which is a publicly traded company. And the point we're trying to make is a lot of things that you guys use on a daily basis, somebody is on the other side as an investor making money. So some of us are consumers, some of us are producers, and some of us are investors, right? So Corey, can you explain the difference between a consumer, producer, and an investor?
Consumer, in the quickest terms I can put it in, is someone who buys things only for personal use, right? So basically, if you have $1 and you buy a candy bar and you eat it, that is a consumer buy. No one else can use that candy bar. Once you've eaten it, you can't resell it. A producer is somebody who puts things out for other people to be able to use and makes money from it, right? So you create something like Mr. Jimmy said, like a record, or if you go to work every day and you help produce work for another company, or if you sell oranges, you know, on the street, anything that you do to produce money makes you a producer, right? So any work that is done makes you a producer. An investor is someone who uses their money to make money. That's the simplest way you can put it, right? So your money is making money. You're investing in other companies. You're putting your money into the stock market or the cryptocurrency market or the real estate market or precious metals or whatever it is, and your money is making money. You're not actively working for the money. You're making, your money is actually doing the money making.
All right, now, a couple questions we got. Facebook is in private. No, Facebook is publicly traded. Their ticker symbol is FB. So it's a public company, but it's a great question nonetheless. I'm gonna tell you why, because there's private companies and there's public companies. Private companies are companies that haven't made shares available to the public. A great example of that in our area in Philadelphia will be Wawa. Wawa is a private company, or Chick-fil-A. Chick-fil-A is a private company. The only way to get stock in Wawa is actually to be an employee. And in fact, even the employees, when they separate employment, have to, sell their shares back. But that's a good example of a private company where the average person from the street just can't go buy shares in it. Facebook isn't one of those companies. They made themselves available to the public via IPO. So Facebook's ticker symbol is FB, and they are a public company. So Melina has a question. Would it be more worthwhile to put money in the bank regularly or do a certificate of deposit? That is an excellent question. I'm going to tell you why it's an excellent question, because what I assume you mean is, as opposed to just having it sit there for emergencies, you can put it in a CD, because a CD does get you a little bit more interest in a regular account. That's a great question. Now,
what the thing about the CD is that it ties your money up, and it has penalties for removing it early.
Now, but that's why I was going to get into it. So there's a strategy with CDs when people want to keep their money into a CD, their emergency money. What they do is they use what's called a ladder strategy, right? So what that means is when you use a ladder strategy, you take and I don't want to keep dwell on this, but I just want to say this to answer your question. If you use a ladder strategy, possibly. And what you do with a ladder strategy is you take a huge amount of money and then you put them in different increments. So one might be 3 months, 6 months, 12 months. So what happens is every 3 months you have money becoming available to you in case you need it. All right. Or you can set it up where every month there's money coming available to you, because like Corey said, you're tying it up. So the way that to avoid the tie up is to use what's known as a ladder strategy. But that's a lot deeper. But to answer your question, yes, it could be if you're strategic with it. What does IPO stand for? Initial public offering. That's when a company that is private decides to raise capital by going public and allowing average investors to invest in it. So an example of that will be Roblox. Roblox recently went public. They were a private company and now they're publicly traded, and they raised money by going public and allowing us to buy equity into their company, which means now you're an owner. The thing about stock, and that's a great question. The thing about stock, a lot of times people look at stocks as just a piece of paper or something on a computer screen. When you own any percentage of stock, you are an owner in that company. So if I go buy 1 share of Apple, I am an owner of Apple. If I buy 1 share of McDonald's, I am an owner of McDonald's, right? So that's it. And another alternative is getting a savings checking with interest. It is, but it probably won't pay as much as a CD. Not that a CD is a great thing, but it's just something to add a little bit extra. All right. All right. Thank you, Melissa, for putting that in there. Yeah, checking account and savings account that pays interest is better than that one that doesn't. It is. Why do you have to be 18 to start doing it individually? Great question. Because honestly, that's the law, right? So you can do it before 18 as long as your parent or guardian signs off on it. The site that we always tell people to go to who are younger than 18, and there's a lot of ways you can do it, but the one of the better sites that we tell people to, as long as you have the approval from your parent or guardian. Let me pull the site up now just to make sure I give you the right name. is Stockpile. And that's STOCKPILE, Stockpile. Stockpile allows minors to set up accounts. They still have to have the approval of their parents, but it allows people younger than 18 to invest in the stock market, right? There you go. Thank you, Corey. Yep. So, and the thing about the rule of 72, what's interesting about the rule of 72 is you literally can just Google the rule of, if you just write down the rule of 72 and you Google the rule of 72, you don't even need the slide. There's a lot of information that'll pop up about it.
The internet is full of rule of 72.
Yeah, because here's the thing about the rule of 72. Most people don't know this because they don't teach you these kind of things in school, but it's out there. Information is out there. So understand that the popular brands, and a lot of times, like from now on, when you go to look at a company or you go to use a product, just Google and see if it's publicly traded. You'll be surprised at how many things you already use, whether it's Adidas, whether it's Nike, some of your favorite restaurants, right? Some of your favorite beverages are all publicly traded, right? So let's see, somebody raised their hand. You got another question?
So all of this is really interesting to me because one thing I'm interested in doing is like majoring in business, and I really like numbers and stuff like that.
Mm-hmm.
But I wanted to ask, so a lot of people mentioned that like Air Jordans are one of their favorite shoes, and I wanted to ask like your perspective from when it comes on like, you know, since Jordan are like one of the most popular shoes, really high in demand and hard to get. Like, for example, they use like the sneakers app to like do a draw on like who gets the shoes and who doesn't. And I kind of wanted to see if you could like speak about that for a little bit, or if you knew about it, because
great question. That is now first off, the Jordan brand is actually a subsidiary of Nike. So Nike owns the Jordan brand. So Jordan is its own brand, but it's owned by Nike. And what you'll find a lot of times with companies is they're separate brands, but they're owned by a bigger company, right? So that's a great question. It gives the opportunity to talk about this. So even Converse is its own brand. That's owned by Nike, right? Reebok is its own brand. That's owned by Adidas. And it's not just sneakers. The car company Lexus is owned by Toyota. So when you buy a Lexus, all you're really getting is a Toyota with a different name on it, right? Ford owns Jaguar, or what's another example? The Acura car is owned by
Volkswagen owns like Maserati.
Yeah,
like,
so
a
like
lot of these companies
Rolls Royce is actually owned by like Volkswagen or something, right? Yeah. So you'll see that a lot in the car companies. You'll see it in the sneaker companies. You'll even see it within the tech industry, as well as clothing, right? Louis Vuitton, don't they own like Pink or something?
Yeah,
like
they
that?
own Pink, DKNY. Like they own like 5 different clothing brands.
So now to go back to your question, if Jordan brand was something that you were interested in, you would have to buy stock in Nike. What happens on the apps in terms of how they make them available, and now you have like sneakers are their own culture at this point. Sneakers have their own culture. People know when the drops are happening. People find ways to use bots to cheat and get in front. That's one part of the business, but the other part of the business is actually just owning the company. You can just own the company. Well, you don't have to worry about getting the actual sneak. Now, if you can get your hand on the sneak, now you can go onto the internet and probably resell that. So the resell business is its own business. But again, the rule of 72 even works with that. Even if you're reselling your sneaks, figure out how much it costs you to acquire the sneak. What did you pay for it? And what are you selling it for? And look at your rate of return and do the rule of 72. So I kind of hope that answers your question about that. But and good luck with your endeavors in business too. I mean, you'll learn a lot about management investing if you major in business. All right. So next thing, I'm gonna talk about Bitcoin for a second. Why you should invest in Bitcoin. And again, this is not investment advice. Please do your own research, and we're not financial advisors. We're just here to talk about certain investment strategies. But cryptocurrency is something that is becoming popular in culture. Corey and I have been doing this for years now, so we have a little bit of knowledge about Bitcoin and about cryptocurrency. But here's why people invest in Bitcoin, right? We talked about inflation earlier. It's a hedge against inflation. As the money supply is increased, money is devalued. So I talked about the cost of goods and services going up. Here's how that happens. It happens by more money being put in the money supply, right? So here's an analogy we always use. Any of you guys like basketball? And if you don't like basketball, it doesn't matter. All you guys have heard of LeBron James. It doesn't even matter if you like basketball. Now, everybody's heard of LeBron James. LeBron is bigger than the sport. So let's just take LeBron James. Let's say that somebody has a LeBron James card that's a 1 of 1, which means that it has value to it, right? And and say I have the LeBron James card, right? I have the LeBron James card as a 1 of 1. I'm like, man, this is worth a lot of money. Only I have it. Corey finds a way to clone that card, make one that looks exactly the same. And he makes a bunch of them. He walks in a room, he knocks my card out of my hand, and he drops all his cards on the floor. And now I can't figure out which one is the real one and which one is the fake one. What did he just do is he devalued the one card I had, because now it's a bunch of them and we don't know which one was the original one. This happens with money every day. Our government is constantly printing money. They're printing and printing and printing money, right? So whether that's like, for a stimulus package or whatever it may be, they're always adding money into circulation. So by them always adding money in, the money that we currently have is devalued. And now it costs more to buy things. So now you'll go to the gas station and it seems like gas is costing more. It's because our money is devalued. So what does this have to do with anything? What does it have to do with Bitcoin? Here's why. Bitcoin is a hedge against that. Bitcoin doesn't operate the same way a dollar bill does. Bitcoin is known as it is the cryptocurrency. It's the most important cryptocurrency, and it's an actual currency that doesn't get devalued because you can't create more Bitcoin. It's impossible to. It's written in the code. There will only ever be 21, right? 21 million Bitcoin. So the fact of the matter is we already know how many will be in existence. So you can't create more, which means that it won't fall victim to inflation the same way that our dollar is. And that's a little bit of a concept, topic, and we can do a whole hour on that. But I just want to expose you to that real fast. Diversification of investments. So we talked about real estate. We talked about the stock market. By adding crypto, now you're known as what's diversified. So Corey, you want to explain what diversification is?
Diversification just means that you're getting into you can diversify in a number of ways. You can diversify within a space, right? So you can buy, if you're in the stock market, you can buy Disney, Apple, Nike. Those are all different kinds of companies. You can buy ETFs, which means you can buy a basket of companies like the S&P 500 is a basket of 500 companies. So you can diversify inside of one investment strategy. Or you can diversify by having different investment strategies. So diversifying using the different investment strategies means like you'll have Bitcoin, you'll have real estate, you'll have precious metals, you'll also have real estate, you'll have all of the things, you'll be on the stock market, you'll have lots of different kinds of investments. Yep. So diversification means to basically spread out your investment money.
Yeah, so it's in different asset classes. Yep. So that's diversification. And historically, Bitcoin has increased in value, right? So over the lifespan, Bitcoin has increased in value. So that's why people invest in Bitcoin, right? So the cryptocurrency space, Bitcoin is the most important. It's the first. It's the most valuable. As of right now, one Bitcoin is over $46,000. The thing about it is you don't have to buy one Bitcoin. You can buy a part of a Bitcoin. You can buy $10 in Bitcoin. But it's a great asset class. And the more you study cryptocurrency, the more you see that this is the future. One of the reasons why I decided to study cryptocurrency and get involved, even coming from a real estate background, is because Mr. Corey introduced me to Bitcoin. And at first I didn't believe it at all, but then I started to study it. And what I recognized is Bitcoin has the attributes of real estate. It has the attributes of the stock market. It has the attributes of precious metals. So in my opinion, Bitcoin is probably the single greatest investment ever created because it has the attributes of all of those things and more. And then past Bitcoin, you have what's known as blockchain technology, which is its own kind of like culture and everything going on. I see the great question we have too. I'm going to answer that in a minute. Matter of fact, I'll answer that right now. You said, can we speak about Forex culture? That's a great question, the way you phrased it, right? Because it is a culture, right? So the thing about the Forex is the foreign exchange market where people are trading money from, say one country or even Bitcoin against another currency. So they find pairs and they trade those pairs. It is a way to make money. But the problem with that is with the internet, people have created like, multi-level marketing Forex things. And it is like a culture where they're always spamming you and trying to get you to join. Just be careful is all I would say about that. Be careful with that because a lot of
it's not a bad investment, right? It's actually the biggest market in the world. but you have to be very careful about who you use as a mentor to get into that market. Because it's the biggest market in the world. It's a worldwide market, the same way cryptocurrency is. It's not a pyramid scheme. Money is
can be though. It can't. And this is why I said be careful.
No. It can be. Like if you get the wrong mentor, you can get put into a pyramid scheme. But Forex itself isn't a pyramid scheme. All right. So Forex itself isn't a pyramid scheme. The same way cryptocurrency itself isn't a pyramid scheme. It's about who you use to teach you to get in. Like they'll be taking your money and then making your investments for you, and then you not get your investments. That's the pyramid scheme part of it.
So
if you learn how to do it yourself and then actually get into the market and study the market and educate yourself about the market, you'll see that it's not an actual pyramid scheme.
But that's why it's a great question, because they're getting a bad rap because of people online. And all you guys that like Instagram, I'm pretty sure they've been in your inbox, because they're in my inbox every day, irritating me. Because it can be a pyramid scheme if they're making their money by recruiting. If anybody tells you you have to recruit people to make money in Forex, then they're not really teaching you Forex.
Yeah,
because if you actually know Forex, you don't have to recruit anybody. So next time somebody recruits you, say, are you trading Forex or are you recruiting? Because you don't have to recruit anybody to do Forex. Let's put it that way. So Renee, thank you for the kind words. Second, let me see, about a best way to learn. So there's a lot of ways to learn.
Oh man,
is a financial advisor a good thing to have? Now,
yes,
it can be. It can be. What I will say about this is now this a lot of things in finance is like it's difficult for us to answer a lot of these questions in depth because of the time we have, but you have to figure out whether they're a fiduciary, right? So, and you can just write that word down, fiduciary. Right. And the reason being is because some financial advisors get paid from the products that they sell. Others get paid by having your best interest in mind. So you have to be careful with that. And again, yes. I've had a securities license. I've worked for big companies on Wall Street. I understand how that culture is. One of the reasons why I no longer do that is because I had a sour taste in my mouth, because I felt as though I wasn't able to serve clients best. I was being told to sell certain products, which is why I said I'm leaving to create my own education firm, because this isn't what I want to do. So just be careful, because some of them are good, but like anything else, you have your good and your bad, right? So that's the answer to the question. It can be, yes. But now, real fast, while we have a little bit of time left, we'll go through this very fast. Blockchain technology, right? So you have Bitcoin, you have blockchain technology. In blockchain technology, people are making millions of dollars in all kinds of crazy ways. And I'm just going to share a couple with you before we get out of here, right? Because I just want to expose you guys to what's going on. Now, cryptocurrency itself is a digital asset created as a medium of exchange, unit of account, store of value. All that means is that it can be exchanged for goods and services. There's a unit of account, so it's measured. So if you have $1, right, that's a unit of account, and a store of value. When you work, you can store your money in something, whether it be a dollar bill or cryptocurrency. Blockchain technology records transactions. It's still a new asset class. Less than 10% of the population own crypto. Its total value is less than Apple or Amazon, which means it's still opportunity here. Here are the biggest. Here's how Bitcoin fares versus the biggest companies in the world by what's known as market cap. And all market cap is the total value. So if Bitcoin was a company, it would be number 7, and it's a new technology. It would be the 7th biggest company in the world, but it's not a company. Apple, by the way, right now, based on market cap, is the biggest company in the world, just in case anybody cared. Microsoft 2 and Google 3, and then Amazon and Facebook, and then Tesla. So Bitcoin is digital real estate. I can go deeper into that, but like I said, we don't have a lot of time. I want to get through this stuff real fast. Bitcoin is digital real estate. So one way to look at Bitcoin is I'm buying digital real estate, right? So NBA Top Shots, right? Here's another example of the blockchain technology being used to create value. NBA Top Shots is a way to have like basketball cards, but they're digital. To a lot of people, this makes no sense at all, right? This makes no sense at all. But look at these prices down here, right? You see USD. LeBron James digital card is going for $250,000, right? And the thing about the blockchain is everything is verifiable. So I can't just put a number up there and say, I could put a number, I can ask for it, but I can tell you exactly what it's sold for, right? So these are real numbers, by the way. And if you look here, This LeBron James card is going for $250, but the last sale of a card similar was $208,000, and that's verifiable on the blockchain. So you can't cap and just make up a number. I can go and see that this card sold for $208,000. By it being digital, it's different than having a physical card in your hand that can actually put a play with the card. So here's what the play looks like on this digital card. That's the LeBron card right there that sold for $208,000. So somebody actually owns this digital card and they can resell it. They actually are reselling it for $250 right now. But so these are assets. These are digital assets. And when LeBron retires, the value of this card more than likely is going to increase. So I'm going to go through real fast. We have a couple more seconds left. I want to share a couple other ways that people are making money on the blockchain, just to expose you to what's going on, right? People are racing horses on the blockchain. There's something called Zed-Run. People are buying digital horses and they're racing them online and they're making money. Anything that happens in the physical world, people are moving into the digital world via the blockchain, and there's an entire culture, technology, and infrastructure that's being built, right? Give you an example. These are actual horses that are for sale right now, and this price isn't dollars. This price is Ethereum. So this horse is selling for 3,142 Ethereum. Ethereum right now by itself is 3,200. So I'm gonna do the math for you real fast. That one horse is selling for
$9 million, $10 million.
$10 million. That horse is selling for $10 million. Just to give you an example of the money that's being generated right now on the blockchain. And a lot of this goes on. The average person doesn't understand it. They don't even know that it's happening, but this is the kind of money that's being generated on the blockchain. So we're just exposing you to this because if nothing else, you can look some of this stuff up. What we're saying is all verifiable. So the cost is supply and demand. Zed horses are very popular. And you can breed the horses and you can race the horses.
We just had something about all of these sites being hacked and all of that stuff. You know how often our government gets hacked? Do you know how often websites get hacked? Like your regular companies get hacked all the time. They just don't put it all over. They don't put it on the news every time it happens. So yeah. Hackers, anywhere there's money, there's going to be hackers to go try to get that money.
Now, the thing about hacks, right, is also this. You can protect yourself from hacks, right? So I actually own 2 Zed horses and no one can hack mine because I use security measures, right? I have a physical ledger that unless someone has in their hand, they can't move it. They can't move it. So yes, everything can be hacked, but it's also security measures you take to make things more difficult for anybody to actually get into. But this is what's happening on the blockchain. We just want to show you that's what's going on here, right? Because at the end of the day, people don't even notice it's happening and millions of dollars are being made. Here's an example of interest that you can get just by putting your cryptocurrency on an exchange right here. I'll just go very fast. If I take my Bitcoin and I put it over here with Sovereign, I can make 50% on my money. Remember the rule of 72? So instead of putting my money to make 1%, I can make 50%. And that shows you how long it takes my money to double. I can go over here. This is what's known as decentralized finance. And like I said, it's a lot of information, but I can make 132% of my money by putting my cryptocurrency over here. This is the kind of money that's being generated in the crypto space where I can make 132% on my money instead of putting it in a bank and making less than 1%. I just want to show you that. Last thing I'm gonna end with is this. Too many people spend money they haven't earned to buy things they don't want to impress people they don't like. That's a quote from Will Smith. The idea of that is a lot of us talk about, creating wealth and using our money to make money, and we feel like we don't have any money. And a lot of times it's because we're spending our money trying to impress people that we really don't like. That's kind of what Instagram is. You see people trying to impress people that when you really think about it, they don't like them anyway. So when you keep that in mind and you think about the rule of 72 and you think about becoming your own bank, you could be a little bit smarter with the money you do have. It doesn't matter whether you work a job, doesn't matter whether you get allowance, however you get your money, that's income. Now, what do you do with that income? That's the question that you guys have to answer. So just want to say thank you for your time. That's our book there, On Your Time and Space. That's our website, bythehood.com. That's all of our Instagram. That's our company. I'm JW the Blueprint on Instagram, and Corey is Above Average Savage, and our company is at By the Hood. But thank you guys for your time. If you guys
have any great questions.
Yeah, thank you for the excellent questions.
Thank you for the great questions.
Yeah, and we didn't have that much time.
Thank you for having us. Awesome.
Yeah, I kind of flew through the end because I knew we were running out of time. But there's so much happening in that space, and I just wanted to show you guys a couple of the things that are happening because a lot of people don't even recognize that people are making millions of dollars, and they it's not even in traditional sense. So thank you guys so much for your time. We definitely appreciate you. And if you guys need anything from us, this is how you get in touch with us. Like, we're here to answer questions and help you any way we can.